Imagine this. It's late afternoon in Washington. The halls of the Capitol are quiet. A marble corridor echoes with the fading sound of footsteps. Inside one of the offices, a senator sits at their desk. The TV is off, the phone doesn't ring. But on the screen, a brokerage account. They move the cursor. Click. Buy. Tens of thousands of dollars in a tech stock. No one's watching. 2 days later, a new bill is announced. That same company's stock jumps 12%. And the trade? It's not illegal. It's not even hidden. It's filed under something called financial disclosure, buried in PDFs weeks after the fact. But if you follow the filings, if you track the patterns, you'll find something Wall Street traders would kill for. A portfolio that almost always moves ahead of the market. Not run by a fund, not managed by a bank, but by elected officials, public servants. How do they do it? What do they know that you don't? Let's take a look at the numbers, because once you see the performance, you'll understand why some people stopped trading stocks and started copying Congress. Imagine you're looking at two portfolios. One belongs to a hedge fund. Dozens of analysts, predictive models, real-time data. The other to a U.S. senator. No Bloomberg terminal, no team of quants, just a law degree, a few committee meetings, and yet, somehow, better returns. In 2021, analysts at Unusual Whales, a site that monitors political trading activity, published something no one expected. They ranked members of Congress by investment performance. And the results? Several senators had outperformed the S&P 500. Some even beat legendary investors. One of the top names? Nancy Pelosi, or more precisely, her husband, Paul Pelosi. His trades, made through public disclosures, began gaining attention for their timing. He bought NVIDIA before a major government chip subsidy. He sold off Visa stocks just before lockdowns were announced. Again and again, the trades aligned perfectly with legislative action. It got to a point where Reddit forums and Discord channels started posting Pelosi trackers. Retail traders weren't laughing. They were copying her moves because they were working. And she wasn't alone. Republican Senator David Perdue made over 2,500 stock trades in a single term. At one point, he bought shares in DuPont de Nemours right before legislation that would benefit the chemical sector. He also sold off casino stocks just before lockdowns were announced. Democrat Dianne Feinstein's husband sold millions in biotech as whispers of a virus began circulating behind closed doors. And yet, no arrests, no scandals, no Senate hearings, because all of it was technically allowed. You see, members of Congress are required to disclose their trades under the Stock Act, a law passed in 2012 to bring transparency to political trading. But there's a catch. They don't have to disclose trades immediately. They have 45 days. That means by the time you see the move, it's old news. And the penalties for missing the deadline? A $200 fine, less than the cost of a dinner in D.C. Meanwhile, the trades themselves can be worth hundreds of thousands, sometimes millions. This isn't about party lines, it's bipartisan. Insider Insight doesn't wear a red or blue tie, it wears a pin. Because when you sit on a Senate committee, you're not just making policy, you're hearing things before anyone else. Company names, timelines, contracts. And while you're technically not supposed to trade on non-public information, no one's watching. No SEC agent shows up, no audit, no subpoena. Just another PDF buried in the congressional record. So what happens when senators start trading with precision Wall Street can't match? The smart money stops betting against Congress and starts following it. But that's just the surface. To understand how this system survives, you have to look at the law designed to stop it and the loophole that keeps it alive. It started with outrage. Back in 2011, a 60 Minutes investigation asked a simple question. How is it that members of Congress can legally trade stocks tied to legislation they're drafting? The public response was immediate. Calls flooded Capitol Hill. Trust, already fragile, cracked a little more. So Congress acted fast. In April 2012, they passed the Stock Act. Its name was perfect. Stop trading on congressional knowledge. It was meant to show that no one is above the law, that senators and representatives would finally play by the same rules as everyone else. But here's the part no one talks about. Just a year later, quietly, with no cameras, Congress gutted the law. They removed a key provision that would have made financial disclosures fully digital and searchable. Why? They said it was a security risk. So instead of a real-time, transparent database, we got scanned PDFs, low quality, often incomplete, and delayed by weeks. And there's more. The Stock Act was supposed to criminalize trading on non-public information, but the language of the law? Vague. Intentionally so. What qualifies as non-public? What if a senator hears something in a closed-door meeting, but it's technically anticipated by markets? There's no clear line, which means there's no enforcement. Since the law passed, how many members of Congress have been prosecuted under the Stock Act? 0. Even when they break it, nothing happens. Between 2020 and 2022, more than 60 lawmakers were flagged for violating the act. Late filings, suspicious timing, unreported trades. Most received a gentle letter. Some paid a token fine. No suspensions, no investigations, no change. Because here's the uncomfortable truth. The law exists, but no one is watching. The Office of Congressional Ethics doesn't have the resources or the authority to enforce anything meaningful. And the SEC? They tread carefully, too carefully. After all, how do you prosecute the people who control your budget? So the loophole isn't hidden in the shadows. It's right there, in daylight, an open door framed by legal language, protected by silence. And while the law remains toothless, the trades continue. Only now they're more careful, more subtle, harder to trace. But there was one moment, brief, undeniable, when the trades were too perfectly timed to ignore. It happened in the days before the world shut down. And once you see the pattern, you'll realize some of them saw it coming. It was early 2020. The news was loud, but the markets were calm. Jobs were up. Travel was booming. Everything looked normal. And then, behind closed doors, something shifted. Inside the Capitol, classified briefings began. No headlines, no leaks. Just small rooms, hushed tones, and a growing sense that the world was about to change. The public, still in the dark. Wall Street, still bullish. But on Capitol Hill, portfolios were already moving. On February 13th, Senator Richard Burr, chairman of the Senate Intelligence Committee, sold up to $1.7 million in stocks. Hotels, airlines, entertainment, sectors that, days later, would plummet. That same day, at a private event, Burr spoke to a group of donors. No media, no public record, but leaked audio revealed a quiet warning about a coming disruption few were prepared for. And he wasn't the only one repositioning. Senator Kelly Loeffler filed dozens of trades in the same window. Her investments shifted away from high-risk sectors and into remote work tech. Senator Dianne Feinstein's husband moved out of biotech. Senator Jim Inhofe trimmed large holdings too. None of it made the news, yet. But the timing, it was uncanny. Weeks later, the market would drop 30%. Entire industries froze. Small businesses closed overnight. Retirement accounts evaporated. But on the Hill, silence. No panic, just well-timed exits. When the trades finally came to light, the outrage was immediate. Editorials, press conferences, even talk of resignations. But as the noise faded, so did the consequences. No indictments, no trials, just the same explanations. These trades were made by advisors, no direct involvement, pure coincidence. And that was it. The system held. Or maybe it protected itself. But something had changed. This time, the public didn't just forget. They started watching. In Discord chats, forums, and subreddits, a new idea emerged. If the rules won't protect you, maybe it's time to track the ones writing them. It started as a joke, a meme, a screenshot of a trade made by a senator, perfectly timed again. Someone posted, "If you can't beat 'em, track 'em." And people did. What began as internet irony became something serious. Spreadsheets turned into scripts. Scripts became dashboards. Soon, there were full-on platforms built by retail investors tracking every trade made by Congress. The most famous? Unusual Whales. A single developer, fed up with the silence, started pulling every disclosure filed under the Stock Act, parsing PDFs, cleaning data, cross-referencing tickers with headlines and votes. And what they found was revealing. Senators buying defense stocks before foreign aid packages, committee members trading tech before antitrust hearings, pharmaceutical plays days before pricing reforms. The patterns were too consistent to ignore. So Unusual Whales turned it into a feed, real-time updates. You could subscribe, get alerts, even set filters. Show me whenever Congress buys semiconductors. The idea spread fast. Finance TikTok picked it up. Twitter analysts started modeling portfolios that mimicked congressional trades. And here's the twist. Some of them beat the market. Not occasionally, consistently. Retail traders were no longer betting on earnings reports or macro trends. They were betting on congressional intent. And for once, it worked. Because if you know a law is about to pass or a contract is about to be signed, you don't need to predict the future. You just need to read the calendar. But behind all of it, a question remained. Why is this allowed? Why does a system that demands compliance from every financial advisor, every hedge fund, every day trader, give this kind of freedom to lawmakers? The answer, it turns out, isn't hidden in a database. It's something else entirely. Older, more protected. It's the unwritten rule that no one dares to break. You won't find it in any document. It's not part of the Constitution. It's not in the Stock Act. And yet, it governs everything. The rule is simple. Power protects itself. Not with secrecy, but with silence, with procedure, with just enough transparency to look legal and just enough fog to stay untouched. On paper, lawmakers are public servants, accountable, transparent, elected. But in reality, they live inside a closed loop, a system where information flows in early and responsibility flows out late, if ever. They sit on committees that hear private briefings from Fortune 500 CEOs. They get early access to budget projections, regulatory shifts, geopolitical risks. They don't need a tip. They are the tip. Imagine being able to see the storm coming and having 45 days to reposition your portfolio. No pressure, no questions, no oversight. If a hedge fund did this, it's insider trading, criminal charges, career over. But if a senator does it, it's a line item in a scanned form, a disclosure event, filed weeks later in a format designed to be unreadable. Because the real protection isn't in the laws, it's in the culture. There's an unspoken understanding. You don't go after your own, not seriously, not where it hurts. The SEC doesn't dig too deep, not into Capitol Hill. The DOJ hesitates. Ethics committees stall. Because who funds these institutions? Who confirms their appointments? Who writes the rules? It's a feedback loop, elegant, quiet, and deeply effective. And when pressure builds, say after a major sell-off or public scandal, the response is always the same: a promise to review, a proposal to reform, a headline cycle that fades in a week. No resignations, no bans, no consequences. Because the outrage is priced in. The system knows how long the public attention lasts. It knows that next month another story will dominate the feed. It bets, correctly, that memory is short. And that's the brilliance of it. The rule doesn't need to be written down. It survives because it works, because it's invisible until it's too late. And the portfolios? They tell the real story. Year after year, certain members of Congress show returns that would raise alarms in any regulated fund. Timing that defies randomness. Trades that echo headlines not yet written. And slowly, people are starting to notice. Not just the traders or the skeptics, but regular investors, the ones who've watched their savings shrink while someone else's wealth compounds, quietly, legally, systematically. This isn't about partisanship. It's not about left or right. It's about proximity to information, to influence, to immunity. Because the further you are from power, the more you believe in coincidence. But the closer you get, the more you see patterns. And if you've ever wondered why some people always seem one step ahead, maybe it's not strategy. Maybe it's not brilliance. Maybe it's just access. The kind of access that doesn't show up on a chart, but moves the entire market one vote at a time. Some secrets don't live in shadows. They live in plain sight, disguised as routine, protected by procedure. And maybe that's the genius of it. No need to hide what no one dares to question. But the next time a policy shifts or a sector suddenly surges, look closer. Someone already moved, quietly, early, deliberately. Because in this game, the smartest play is being inside the room before the door even closes.